The Federal Reserve met once again to set the rates and decide our fate. What are they doing, and is it going to save us from a crisis? Are they the ones causing the crisis? Let's find out. After the recent failure of SVB and a bunch of other banks because of higher interest rates, the Fed was faced with a seemingly impossible balancing act to stabilize the banking system at the same time as trying to fight rising prices. If they continue to increase rates, inflation will go down, but so will the banking system and the economy will collapse. Because increasing rates makes borrowing more expensive, which slows demand and economic activity. And if they bring the rates down, inflation may stay, pushing them further away from their goal of achieving a sustainable 2% level of inflation. That's why everyone's been talking about whether they're going to do more rate hikes. And yes, they decided to raise the interest rates for the 9th time in a row. Before SVB crashed, they were going to increase the rates by 0.75% and eventually decided to increase them by 0.25%, indicating that hikes are near an end. Powell reassured the public that they have the tools to keep the banking system and the economy healthy. And if when they say tools, they mean their money printer, that's not going to help. Biden said he's committed to holding those responsible for this mess fully accountable. Don't worry, Joe, we'll help you. Here they are. But what tools do they have, and how can they influence the economy? The Fed has two main roles known as the dual mandate. The first is to keep unemployment low. The second is to keep prices stable by keeping inflation under control. They also control the money supply. They also clear checks and wire transfers. They also try to keep the housing market and the whole economy healthy, and to keep the stock market stable, because that's what the big companies want. By the way, doesn't it seem like the Fed has a bit too much on their plate and maybe a bit too much power? We'll talk about that in a bit, but let's get back to the mandate. Even their two roles can be conflicting. Sometimes you have high unemployment and high inflation, so the Fed needs to get rid of both, but it's hard to do both. Because if you have high unemployment, you need to increase the money supply. But increasing the money supply leads to more inflation. When there's too much inflation, it makes sense to decrease the money supply, but doing that brings up unemployment. Let's not forget the Fed has been taking some unprecedented actions recently. First, they responded to the COVID crisis with quantitative easing, or QE, aka printing lots of money. This was first introduced under Ben Bernanke in March 2009, following the stock market crash of 2008. It's not like they just print money and give it out to people, except, yeah, that's what they do. They give it to banks first. To do this, central banks buy government bonds and other securities, thus injecting the Fed's reserve into the economy. When the supply of money is increased, this lowers interest rates. Credit becomes cheaper. This gives the banks more liquidity and lets them lend on better terms. 2008 was the first time the federal funds rate was brought down to zero. And that's how the economy has functioned for the most part since then, on low interest rates and cheap credit. In 2020 alone, they printed $3.3 trillion, which was 1/5 of all US dollars in existence. That way, instead of a much bigger COVID crisis and recession, the longest bull market in history continued. Did they stop printing money? Of course not. They ended up creating $7 trillion in 30 months, flooding the system with new money. But of course, this way money loses its value because you're not creating any new value or increasing productivity, you're just diluting the value of existing dollars. In response to the recent banking crisis, the Fed has injected $300 billion into the US banking system. Whether or not you call that a bailout, when new money is created, everything becomes more expensive, and that is carried on to the consumers. Another thing is the rate hikes themselves. In 2022, they increased the rates from 0 to almost 5%, which is the most drastic increase in history. The highest Fed funds rate was 20% in 2020, in response to double-digit inflation at the time. What is this federal funds rate that the Fed sets? It's like the wholesale rate at which banks lend money to one another. Now, if it becomes more expensive to borrow, this not only affects families when they need extra money, but any kind of business activity becomes more expensive. So the Fed flooded the system with dollars like never before, and then increased the rates like never before, which is why some experts warn of a big economic downturn. As the US national debt is getting bigger and bigger, there are big questions about who the Fed actually benefits. It's quite obvious that it puts the banks and corporations before ordinary people, but the Fed itself is run much like a private organization. So realistically, the Fed is probably going to continue to do whatever they want until a crisis becomes so big they can't deal with it, so the next administration can blame everything on this one, and the cycle will continue. Powell has said that we have a bumpy road ahead to low inflation, so let's hope that we'll have a relatively soft transition. Subscribe to this channel to find out more about money and investing. All the best, and see you soon.